Hello friends, welcome to Easy Learning Economics. I am Dr. Keval. In the previous lecture, we covered the basic knowledge with regards to exchange rate, in which we covered that what is exchange rate, what is the high and low exchange rate, what is the appreciation of currency, what is the depreciation of currency, and how does the exchange rate affects on the demand for and supply of currency. So if you have not watched, you can watch that video. The link is given in description box. So in this lecture, we shall discuss that what is exchange rate and its types. Exchange rate is the price of one country currency in terms of another currency. Exchange rate can be fixed exchange rate or pegged exchange rate, flexible or floating exchange rate. Exchange rate can be pegged float exchange system or crawling pegged exchange rate system. Exchange rate can be a forward exchange rate, a spot rate, nominal exchange rate. Exchange rate can be a real exchange rate, onshore currency rate, offshore currency rate, and quotation acronyms and currency pair rate. So in this lecture, we shall discuss all these things, whatever we name called. Here, one thing we must know before to start the exchange rate in its types, the basic difference between currency devaluation and currency depreciation, revaluation and appreciation. Most of the people are unaware about this thing, so I would like to impart this information. Two terms we mostly use whenever we talk fixed exchange rate, that are devaluation and revaluation of currency. We need use the term appreciation and depreciation of currency if we talk flexible exchange rate system. If you want to learn more about appreciation of currency, depreciation of currency, you can watch my previous lectures. The links are given. So without wasting time, we start that what is fixed exchange rate regime. Fixed exchange rate is also known as pegged exchange rate system. Under fixed exchange rate system, the government decide the exchange rate between two countries. Central bank holds large amount of domestic and foreign currency reserves. Central bank ties its currency with major currencies like dollar, euro, pound, and tries not to deviate from its targeted exchange rate. So what is flexible exchange rate system? Flexible exchange rate is also known as floating exchange rate. Under flexible exchange rate system, equilibrium exchange rate is determined through global supply and demand for currency. It means market demand and supply forces decide exchange rate or price that may change frequently as per the fluctuation in demand for currency and supply of currency, and central bank does not involve to fix or peg the exchange rate. The decrease in demand for and increase in supply of currency causes depreciation of currency, and an increase in demand for and decrease in supply causes currency appreciation. The flexible exchange rate system helps in making automatic adjustment in balance of payment, but on the other side, it discourages the international trade and investment by volatility of an exchange rate and uncertainty. What is crawling pegged exchange rate regime or system? Crawling pegged is also called the pegged float exchange rate system. In case of economic instability and threat of devaluation due to inflationary pressure in the economy, the crawling pegged exchange rate system with fixed exchange rate system allows the currency to fluctuate between upper and lower bound rates. The government makes small adjustment in the fixed exchange rate in order to respond to changes occurring in the quantitative economic indicators like inflation, economic growth, and price, and avoid uncertainty and volatility of an exchange rate system. So what is spot rate? Spot rate or spot price is the current price or today exchange rate in the current market at which the foreign transactions in terms of immediate settlement of the commodity, security and currency is made as per the contract. Mostly within 2 days, the transactions are performed and completed. Spot rate is direct rate at which the number of domestic currency units can buy 1 unit of foreign currency. Spot rate changes with market demand for and supply of currency. So what is forward exchange rate? Forward exchange rate is also known as forward contract. The current agreed exchange rate at which the transactions will happen at a specified date in future is called forward exchange rate. Suppose a company expects to receive 10 million euros after 30 days, can make a forward contract to deliver 10 million euros after 30 days and receive equivalent US dollar in 30 days at an specified exchange rate today. So this is called forward exchange rate or forward contract. So forward exchange rate is equals to spot rate multiplied by 1 plus domestic interest rate divided by 1 plus foreign interest rate. What is nominal exchange rate? The nominal exchange rate is basically a relative exchange price of currencies of two countries' world market. For example, rupees 170 are equals to 1 US dollar. It means that Pakistan can exchange 170 rupees for $1 in the world market. What is real exchange rate? Real exchange rate simply is the price of domestic goods relative to the price of foreign goods. It compares the general price level of two countries and assess export competency of the country. Real exchange rate is equals to nominal exchange rate multiplied by the domestic price level divided by foreign price level. It means the real exchange rate between two currencies is the nominal exchange rate multiplied by the ratio of the price between two countries. After converting the domestic currency into foreign currency, the real exchange rate tells how many goods in abroad the currency can buy in comparisons to domestic goods. What is onshore currency? Means buying and selling of currencies in domestic economy, means trading in rupees at domestic level in the onshore market, means local market. What is offshore currency? The rupee would be offshore if it is traded at international level in the offshore market, means overseas market outside the mainland area of Pakistan. Then the rupee would be the offshore currency. Then rupee would be traded freely and shall be used for rupee payments to and from business inside and outside of Pakistan. What is quotation currency or pair rate? The quotation currency pair is here suppose 1 US dollar per 170 Pakistan rupees. Means that 1 US dollar is exchanged for 170 Pakistan rupees. In this case, US dollar is the base currency and Pakistan rupee is the quote currency, means counter currency. This means that $1 can be exchanged for 170 Pakistan rupees. It is all about the exchange rate and its types. I hope that you have enjoyed this lecture. If you have any queries and comments, let me know in the comment section. Thanks for watching.